So learning objective two in this chapter basically introduces you to a few ratios. Um, Ratios are used to financially evaluate a company's health, right? And so you're going to be learning a few common ones here that we use pretty frequently regarding the profitability of the company, whether the company has adequate liquidity, and whether it's going to be solvent for the long term. So first of all, just the idea of a ratio sometimes, confuses people. It's basically a relationship between two numbers, and the numbers you have been compiling on the income statement and the balance sheet are the numbers where we use those numbers to do our ratios. Okay. So you're going to learn very specific ratios, but the numbers are going to come from the statements. We use analysis to understand the health of a company, just like your doctor would uses ratios to understand your health. So when you go to the doctor's office for a medical checkup, physical exam, what have you, they're looking at a whole bunch of numbers to evaluate your health, and that might be your weight, your height, your body mass index, might be your blood pressure, might be your cholesterol, HDL, LDL ratios, and so forth and so on. There's a whole bunch of numbers they look at to evaluate your health, and if some of the numbers are a little bit off, they will concentrate on that. Well, that's what accountants, financial analysts, and managers do with ratio analysis. It just basically gives you a picture of the company's health financially. And one number in and of itself doesn't really necessarily mean much, but taken as a whole, you kind of get the big picture. And that's what the purpose of it is. So let's take a look at a few. So first of all, the first one you're going to be looked into is profitability ratios. And again, remember, corporations are owned by stockholders or shareholders, right? So when a company does make a profit, right, revenue minus expenses gives you that profit, right, net income or the earnings. You're a stockholder, you might have just one share of stock in a company. That still makes you a stockholder, by the way. Well, the company just made a ton of profit. How much of that is mine? How much of these earnings are mine? Well, that's what the most popular profitability ratio will tell us, called earnings per share. And we're going to look at that. Then we look at ratios regarding liquidity. Liquidity means the ability to turn something into cash quickly. So obviously cash is already cash. But when you look at other assets, like you did on the balance sheet, classified balance sheet, the current assets are listed first by liquidity order, how quickly these assets will turn into cash this year. All right. So that's why accounts receivable is listed there, and then notes receivable, inventory. Eventually, they'll all be turned into cash. So why do you need cash? Well, that's how you pay your bills. So liquidity ratios measure really the company's ability to pay its current bills, because you need to pay rent. Your landlord only wants cash. You need to pay your employees. Your employees only want cash. So you need cash to pay your bills. Liquidity ratios will show us that. A solvency ratio is really about the company's ability to manage its debt, long-term debt. Now, debt in and of itself isn't necessarily a bad thing. It depends on what it's used for. And it also depends on how much you have, because you have to finance that debt. So you have to keep paying interest on the debt. And of course, you have to pay the loan off as well. So this is a long-term process. Many of these loans last for some time, maybe 5, 10, 20 years. So how is the company's ability to manage that will help it survive? So we look at something called solvency ratio. The biggest one is the amount of debt that it has compared to its assets, to see how it's doing. So let's introduce you to, again, these financial statements, which all the numbers come from the ratios. This is an income statement from Best Buy. It's a comparative income statement. It shows Best Buy's years here for 2013 on the far right, 2014 sort of in the middle. Again, it starts with revenues because revenues are only on the income statement. It lists your expenses. Again, expenses are only on the income statement. And it gives you your net profit or loss. And as you see, Best Buy in 2013 had a loss because their expenses were larger than their revenue for that period of time. Right. But in 2014, the most current year on this statement, their revenues were larger than their expenses, and so they ended up having a profit. Now, this might look like a small number, 532, until you realize that all of these numbers are in millions, so you have to add 6 zeros to get the right number. So this is a $532 million profit on over $42 billion of sales. Okay, so so this is quite a bit of money. So whose profit is it? It's the owner's profit. You're a shareholder. How much of the profit is your share going to get, right? And so that's basically what earnings per share tells us. If you looked at this profit and you're a shareholder, how much of that profit is for your share. So earnings per share, remember the word earnings means net income, means profit. Earnings is the same as profit and net income. They're all interchangeable. Please remember that. So earnings per share of ownership, because corporations are broken into shares of ownership. So out of all of those earnings, what's my share of it as a stockholder per share? You can have more than one share, clearly, but as we look at it as a per share basis. So we're going to focus on 2014 numbers here. Here they have a profit of $532 million. And then how they divide it up for earnings per share is they look at how many shareholders they had through the year. Now, here in 2014, you see that at the beginning of the year, and again, this is in millions, they had 338 million shareholders. But by the end of the year, they had 347 million shareholders. And that's because companies sell shares to raise money. And so during 2014, they obviously sold some shares to raise some money. They take the average of these two numbers to split up the earnings per share. Okay. That doesn't happen all the time. As you see in 2013, they actually started the year with 341 million shares of ownership. At the end of the year, they had 338 million shares of ownership. That actually decreased, and that's probably because the company bought back shares. Okay. And so those shares are not what they call outstanding or owned by the public. So here is the formula, earnings per share, net income minus, well, preferred dividends. This is an interesting thing because 95% of the time, roughly, it's going to be zero because in order to have preferred dividends, you need preferred stock, and most companies don't have that. So it's technically the net income divided by the average shares, which, like I was telling you, the average of these numbers here. So in 2014, if they split up that $532 million profit per share of ownership, each share would have earned $1.55 of that profit. Okay. Now, clearly, that was better than the previous year where they lost money. So again, the wonderful thing about a company is when it's profitable, the profits are owned by the owners. That's really good. But the loss is also owned by the owners. So if owners want to continue their business, right, they have to cover the loss. And so for a large corporation, this loss is covered through retained earnings. But for small businesses, as you've seen on the television or news reports of so many of them closing, it's because when they have a loss, the owners have the same decision to make. Do I cover the loss to continue in business, or do I just stop because I just can't cover it? And when they just can't cover the losses, they just stop doing business. And you've seen a lot of that this past year, the last 12 months. So in this case, each share in 2013 had to cover a loss of $1.30 per share. So clearly you want the profits to increase year to year, quarter to quarter, and year to year, because in general, this is what used to drive stock prices higher. I can't say that for the current market, but this is definitely the basis for stock prices. Is the more valuable shares are because your share is earning money. Your share is earning money every year, turning more and more, so it's more valuable. So here's a review question from a company, Stolen Company. They had a profit of 26,000. They had net sales of 400,000. Now, again, in accounting, you're going to get a lot of numbers. You don't need some of them. You don't need some of them. Here, we're looking at earnings per share, and sales, we don't care about sales because sales is not part of the formula. What's part of the formula is net income, right? Average outstanding shares, 6,000. That's also part of the formula. And of course, sorry, it's a textbook, but they paid $2,000 of preferred dividends. So in essence, you start with the net income, you subtract out the preferred dividends, so you get $24,000 of profit, and you divide it by the shares outstanding of 6,000. And so the earnings per share would simply be $4 per share. Every shareholder would be basically what their share would have earned $4 in profit that particular year, 2017. Now, how does that compare to the previous year? That's what I would look at to see whether the company is becoming more valuable or less valuable. The classified balance sheet is where we look to find liquidity related issues and solvency, because we look at its ability to pay its current bills. So that means we're going to be looking at its current assets to pay its current bills, current liabilities. So we're going to be looking at these two figures for Best Buy. This is their balance sheet. And again, this is also in millions. And so even though this looks like 10,485, it's actually 10,485 million. Same thing with its liabilities. That's $7,436 million of liability. So we use these numbers to look at its ability to pay its bills, because how do you pay your bills? You pay your bills from, believe it or not, your current assets turning into cash. And so that's how you pay all these current bills that you have. Then, of course, we look at long-term debt for solvency. So we look at the total amount of debt the company has compared to the total amount of assets the company has. And that's going to tell us its ability to remain solvent, in other words, manage its debt for the long term. So these are where the numbers come from. And let's take a look at what we've got. So liquidity, again, looking at the ability to pay its bills that are due now, this particular period, this year. So the first thing they introduce you to is something called working capital, which is not a ratio. Actually, it's simply the amount of current assets and subtract out the amount of current liabilities. The remaining amount is considered working capital. So Best Buy, as you know, had current assets of over $10.4 billion. It had current liabilities of $7.4 billion. So the difference, simple subtraction, would mean that their working capital would be $3 billion, okay, which is good. But more importantly is something called a current ratio. This is a ratio that's used throughout businesses. It's very common to talk about a current ratio. And a current ratio simply is looking at the current assets compared to the current liabilities. That's all we're doing. Okay. Some people look at this and see a math formula. I see a story. I see a story between what's the relationship between how much current assets they have compared to how much current liabilities they have. Okay. So for Best Buy in 2014, they had $10,485 million of current assets. When you compare that to the $7,436 of current liabilities, you will get a ratio of 1.41 to 1. And what this means is that very first number represents the current assets, and that number represents the current liabilities. So how you would read this is basically that Best Buy has $1.41 of current assets for every dollar in current liabilities. So in this case, they have much more than 1-to-1 ratio, which means that they should be able to cover um, their their current bills pretty well. Compared to last year, where their current ratio is only $1.11, $1.11 of current assets to every dollar in current liabilities, they've increased that. They're in a better position. They're in a more liquid position. They have access to more cash coming to pay their bills than they did previously. H.H. Gregg is a competitor of Best Buy. It's basically a retail store like a Best Buy. If you walked into an H.H. Gregg and you looked around, you'd think, hey, I'm in a Best Buy. But it is down. I've been in an H.H. Gregg. I think it might have been in Maryland or Virginia, but it's sort of like that towards the southern part of the East Coast. That's where they're more prominent. And as you see, their current ratio is 1.68-to-1. And again, this first number represents the current assets. So they have $1.68 of current assets. And remember that last number represents current liabilities to every dollar in current liabilities. So $1.68 is a lot more, right? A lot more coverage for every dollar in debt. They have $1.68 of current assets. So H.H. Gregg's in a really good position to make sure they're able to pay their short-term bills compared to Best Buy, although Best Buy's in a good spot. Now, when I went to school way back in the day, as I rode my pet dinosaur into school, 2-to-1 was really sort of the ratio we were looking at as something that was really healthy for a current ratio. So clearly they're doing pretty well in this regard. Different story for the industry. So this particular industry is the electronics retail industry. So all these stores that have basically known for selling electronics goods like Best Buy is. They're in pretty rough shape. Their current ratio is 0.88-to-1, which means they only have 88 cents of current assets for every dollar in current liabilities, which means this particular industry is stressed. And then that's true, because in order to pay their current bills with this type of ratio, they're going to need to borrow more money, okay, if they're able to. So you can still, even though the ratio is below 1-to-1, which is not ideal, you can still survive. I don't know how much longer. But this particular industry is under considerable stress as it is. You probably back in when you were very, very young, you might remember Circuit City stores being around. They were a main competitor with Best Buy here. And of course, they've gone by the wayside. And in more recent history, when just within the last couple of years, Radio Shack has also disappeared for the most part. That's also part of this industry. So it's a very, very difficult industry. It has been more and more difficult through the last 10, 15 years. Okay. All right, solvency is that ability to do two things. They need to pay back their debt when it's due, but they also have to pay interest on the debt, and that interest is an expense. And so, how are they positioned for the long term? So that's the debt to asset ratio. It simply looks at the total debt of the company, so the total liabilities, compared with the total assets. Okay. So for Best Buy in 2014, when you look at this ratio, they have over 10 billion of total liabilities. They have over 14 billion in total assets. When you compare these two numbers, the total debt represents 72% of that, which means in essence, they had to borrow for all these assets, $14 billion worth of assets. 72% of those assets were financed with debt. Okay. So for every dollar in total assets the company has, they had to borrow 72 cents to buy that dollar of assets. Okay, that's what that means. Now, clearly, in 2013, they had a higher debt to asset ratio, so they were very, very much more reliant on debt in 2013 than they were in 2014. The fact that this has come down in that period is good for them because that means they're managing less long-term debt. H.H. Gregg for the same year, 2014, they're in an extremely strong position because basically with a 51% debt to asset ratio, that means they have about 51 cents of liabilities for every dollar of assets. Okay, and so that's how you would read that. The industry is stressed, no doubt about it. This industry has an outrageously high debt to asset ratio. So for every dollar in total assets, they have 88 cents of debt for that. So this is too big a number for retailers. That's all these guys are. Best Buy, they're just retailers. They just retail. And so they don't make anything. So this is a very, very high debt level to carry. It doesn't mean that this debt level wouldn't be okay in certain industries. I mean, if you're a manufacturer like Tesla or General Motors, having a very high debt to asset ratio doesn't mean much to me because in order to buy and to build cars, you need factories that cost money. You need equipment, robotics, other stuff. All that costs money, and you're going to borrow. Most of the time, you're borrowing money to do that. So that doesn't bother me all that much. Airlines as well. In order to run an airline, you need airplanes. Airplanes cost a mint. And so where do companies get that money to buy all those airplanes? They usually borrow most of it. So a high debt to asset ratio doesn't bother me in certain industries, but this is retail. They don't make nothing. They just resell stuff, right? So this is why you've seen other companies like Toys R Us go out of business. They had an incredibly high debt to asset ratio. They could manage that amount of debt. J.C. Penney is under substantial debt. And closing out of stores. Same with Macy's, they're retooling. So too much debt for certain industries is not very good. And again, every company will have different debt to asset ratios. Again, this doesn't bother me that GM has a very high one. It doesn't bother me that even ExxonMobil has a relatively high one as well, because they just have a lot of equipment. They just do. So, and most of that is financed with debt. We don't need to worry about the statement of cash flow. So we're not doing the free cash flow in this particular part. But the ratio analysis, those ratios are important. Again, here you have 2 years of numbers. This is the one that's done for you in the book or online. And for different ratios, you need different numbers, right? So for your current ratio, you're going to need your current assets and current liabilities, right? For your debt to asset ratio, you're going to need your total liabilities and your total assets. See? So, and for your earnings per share, you're going to need net income minus preferred dividends divided by average shares. So just know what data you need to do things. And these things work out quite well. So the earnings per share for this company, Ozone, for 2017, you have net income minus preferred dividends divided by average shares, $1 per share. In 2016, net income minus preferred dividends divided by average shares, 80 cents a share. So clearly they have more earnings per share, which is a good thing. Okay. The current ratio, as you know, is the current liabilities compared to the current assets on both sides. So in 2016, it was 1.6 to 1, 2017, 2.2 to 1, extremely strong, much better here. Debt to asset ratio, as you know, is just two numbers, your total liabilities on the top, total assets on the bottom, right? And so here in 2016, they had a 44% debt to asset ratio, 2017, much lower at 30%. Okay. So I'm going to come back to our main screen, ask you to populate and ask any questions you might have.